The trade war between the United States and China has escalated dramatically. On April 10, 2025, Trump imposed new tariffs on Chinese imports. These tariffs now total a staggering 145%. This includes a recent increase from 84% to 125%. Additionally, there is a new 20% levy specifically targeting fentanyl-related imports. China wasted no time in retaliating. They slapped an 84% tariff on U.S. goods. This tit-for-tat exchange has sent shockwaves through the global economy. Businesses and markets are on edge. The tariffs represent a significant escalation in the ongoing trade dispute. Both sides seem entrenched in their positions. The possibility of a negotiated settlement appears increasingly distant. The impact of these tariffs is already being felt. U.S. exporters are grappling with rising costs. Chinese manufacturers are facing shrinking demand. The situation is volatile and unpredictable. The financial markets have reacted swiftly and negatively to the escalating trade war. The Dow Jones Industrial Average plummeted 3.4%. The S&P 500 index tumbled 4.2%. The tech-heavy Nasdaq experienced the sharpest decline, plunging 5%. These drops represent billions of dollars in lost value. Investor confidence has been shaken. Fears of a global economic slowdown are growing. While U.S. markets suffered, European and Asian markets initially saw gains. However, these gains were short-lived. As the gravity of the situation sank in, these markets also succumbed to selling pressure. The S&P 500 index has fallen approximately 6% since April 2nd. This was when the initial tariff announcement was made. The markets are clearly signaling their concern over the trade war's potential impact. The Trump administration argues that these tariffs are necessary. They claim they are defending American interests. Their stated goal is to rebalance trade with China. The administration accuses China of unfair trade practices. These include intellectual property theft and forced technology transfer. They also point to China's massive trade surplus with the U.S. The administration believes these tariffs will protect American jobs. They hope to encourage companies to bring manufacturing back to the U.S. However, critics argue that the tariffs will harm American businesses and consumers. The administration also cites China's role in the fentanyl crisis. They aim to use tariffs to pressure China into curbing the flow of this deadly drug into the U.S. Despite the administration's tough talk, there is confusion within the U.S. government. Senators and even some of Trump's own trade officials have expressed uncertainty. They are unclear about the specific goals of the tariff strategy. The endgame remains shrouded in mystery. This lack of clarity has fueled criticism. Opponents argue that the administration lacks a coherent plan. They fear the tariffs will do more harm than good. Adding to the confusion is the proposed Mar-a-Lago Accord. This ambitious plan aims to restructure global trade. Details remain scarce, but experts have expressed concerns about its feasibility and potential consequences. Beijing's balancing act, retaliation, and restraint. China has denounced the U.S. tariffs as economic bullying. They insist on negotiations based on mutual respect and equality. They accuse the U.S. of backsliding on previous commitments and undermining the global trading system. While retaliating with their own tariffs, China is also treading cautiously. They are aware that a full-blown trade war would harm their own economy. They are strategically reducing their holdings of U.S. Treasury bonds. However, China is also sending a clear message. They are prepared to withstand a protracted trade war. They are willing to endure short-term pain for long-term gain. They believe that ultimately, the U.S. has more to lose. A 90-day reprieve, uncertainty looms for all but China. In a surprising move, President Trump announced a 90-day pause on tariffs for most countries. This pause is intended to allow for negotiations and potentially avert a full-blown trade war. However, China was explicitly excluded from this reprieve. Former Treasury Secretary Janet Yellen suggests this pause was prompted by market instability. She points to the falling prices of U.S. Treasury bonds as a sign of investor concern. The administration may be feeling the pressure to de-escalate the situation. Despite this temporary reprieve, uncertainty still hangs heavy in the air. The exclusion of China suggests that the core issues in the trade dispute remain unresolved. The Mar-a-Lago Accord, a new world trade order? Adding another layer of complexity to the situation is the proposed Mar-a-Lago Accord. This accord, shrouded in secrecy, aims to fundamentally reshape global trade. Details are scarce, but experts believe it could involve a devaluation of the US dollar. Proponents argue that this devaluation would make US exports more competitive. However, critics fear it could trigger inflation and undermine the dollar's status as the world's reserve currency. The Mar-a-Lago Accord has been met with a mix of skepticism and apprehension. Its potential impact on the global economy is difficult to predict, but it underscores the Trump administration's willingness to upend the existing trade order. Collateral damage. Businesses and consumers feel the pinch. While the trade war rages on, businesses and consumers are feeling the brunt of the impact. U.S. exporters to China, a market worth $144 billion annually, are facing rising costs due to the tariffs. This is forcing them to raise prices, cut jobs, and reevaluate their supply chains. Chinese manufacturers who rely on the U.S. market, which imported $439 billion worth of Chinese goods last year, are also struggling. They are facing shrinking demand and mounting pressure to find alternative markets. Consumers on both sides of the Pacific are also feeling the pinch. Prices for everyday goods, from electronics to clothing, are rising as tariffs take their toll. This is putting a strain on household budgets and dampening consumer sentiment. The currency conundrum: dollar dominance versus devaluation. The trade war has also ignited a debate about the future of the U.S. dollar. The dollar's status as the world's reserve currency grants the U.S. significant economic and geopolitical leverage. However, some argue that this dominance is unsustainable and even harmful. The proposed Mar-a-Lago Accord, with its potential for dollar devaluation, has fueled these concerns. While a weaker dollar could boost U.S. exports in the short term, it could also trigger inflation and erode confidence in the U.S. economy. China, meanwhile, has been steadily promoting the use of its own currency, the yuan, in international trade. While the yuan is not yet a serious challenger to the dollar, the trade war could accelerate its rise and potentially reshape the global financial order. A world on edge. The future of global trade hangs in the balance. The escalating trade war between the U.S. and China has cast a long shadow over the global economy. The consequences of this conflict extend far beyond the two economic superpowers. The rules-based trading system that has underpinned global prosperity for decades is under threat. The outcome of this high-stakes standoff remains uncertain. The potential for a negotiated settlement seems increasingly distant. The economic fallout is already being felt worldwide. Businesses are struggling to adapt to the uncertainty. Consumers are grappling with rising prices. The world is watching anxiously as the two giants clash. The stakes are high. The outcome will determine not only the future of U.S.-China relations, but also the shape of the global economy for years to come.